Let's get started.
Welcome to the Financial Purpose Podcast. All opinions expressed by me or guests of the podcast are solely our own opinions and do not reflect the opinion of Life Moves Wealth Management. This podcast is for informational purposes only and should not be relied upon for any investment decisions. Clients of Life Moves Wealth Management may maintain positions in the securities discussed in this podcast. Hey, welcome back to the Financial Purpose Podcast. I'm your host, Dale Shafer. This is episode 93, and today's topic is one that I didn't actually want to even talk about because at this point I think I feel like I've beat this horse a lot. But last week I was in a conversation. It brought this back around. I thought about it a lot over the weekend and over the couple of days since the situation. And I thought, you know what? Maybe we're going to talk about this again. And this may be the last, I think, in the series. I've spent the past few weeks going through all the ways that the approach that we take at Life Moves Wealth is vastly different than the traditional wealth management approach, which is not built for most business owners. It's not built for a lot of higher net worth clients. And there's a big difference in the way that we approach wealth management through the BOSS method compared to anything else that you might see on the market. So today, I'm going to hit that a little bit more because I was in a conversation last week with a business owner, and I drove all the way out to their home. It was a decent drive for me through the valley, and we had a very quick meeting, went through, here's all the things that I'm going to do, here's all the things that they've identified are important to them. This is what they want their advisor to do. More importantly, this is what they don't want the advisor to do. And we were very well aligned at the time. And so I took my notes, sent the proposal, and a couple hours later had an email back that just said, wow, you're kind of expensive. And what would stop me from, instead of going with you, going with this name shall be withheld to protect the guilty investment firm online? And my thoughts were deep and wide on the answer to that question. So rather than telling you what I said, I'm going to talk about it today in the episode because it's going to expand on what I said in answer to that. Because if we're doing work the right way, your advisor should cost more than an online platform, and there should be an awful lot of value attached to that price tag that's far and above what you get with the online platform. So most advisors won't talk about a lot of things that I talk about because the incentives don't favor that. Here's what I mean by that. So if you've met with a financial advisor, they're showing you usually part of the picture. Most of the time, it's the investment platform. It's the asset allocation. It's the 1 year, 3 year, 5 year, 10-year returns, all of which are very important. They might show you some life insurance calculations. They might show you some life insurance policy options. They might show you some mutual funds and ETFs and stocks. They might show you a list of portfolios that they've built. They might show you some tax-advantaged annuity programs or things like that. So you've had portfolio reviews. You've had retirement projections. Has anyone ever dug into your tax strategy or helped you think through how your business is performing and how to maximize value and even how to manage cash flow, both personal and business? Have they mapped out how your wealth accumulation will impact your children or your parents? Because for a lot of us, we're in that quote unquote sandwich generation. That's a very important consideration as well, because the more wealth you accumulate, there are more tentacles attached to that wealth. As our kids would say, mo money, mo problems, right? And if all of this sounds familiar, then I want you to listen to this episode because it's very important. I need to pull back the curtain on some things that is vastly different between real financial advice versus just simple stock jockey, stock picking, investment management. So let me first I said that the compensation structures don't favor a lot of this. Let me break that down real quick. So advisors are paid predominantly in two ways at this point. There's kind of a third. Let me start there. That would be commission. And there used to be commissioned trading. You would have more stock allocation. The broker, because they were a stock broker or a bond broker, they would call you. They would say, I have 20,000 shares of Google that have just been released on the platform. I'd like to recommend that you buy 100 so we have a round lot of shares that can be traded, and we can put options on them so that way you can earn extra income. And that's how that worked. And so when they completed the sale and traded the shares, then they got a commission on the ticket charge. That transitioned into managed accounts or assets under management. And the same thing applies. It's a percentage of the assets that are under management. So it's no longer a percentage of the ticket charge or the trade amount. It's now how much is in the account times 1% or 1.25% or 80 basis points if we're getting competitive or something like that. And then the other way to do it is through some sort of fee-only flat fee basis. And even on the AUM, there's still some commissions for things like life insurance and annuities. On the fee-only platform, that's it. The only person who can pay the advisor is the client. So Life Moves Wealth, when I launched the firm a little more than 3 years ago, made a conscious decision to go fee-only, where the only person who could pay me is the client. There's no commissions on any products. There's no kickbacks from any mutual fund providers. There's no share of revenue from a private placement of a real estate or a REIT or a opportunity zone fund or anything like that. And so the uncomfortable truth about how this works is people are going to spend time on the things that they get paid for. So if your advisor is incentivized to manage money, they are going to spend time on the investments and collecting more money from new clients and continuing to collect more money from new clients, because that's what the game is about. It's about how much asset growth have you had this year, and that usually will tell your firm whether or not you're a good producer. Whatever happens with your clients is kind of important, because as long as you're keeping assets, right, you're not leaving, or assets aren't leaving you, I should say. Assets are staying in place. You're growing assets. That's how the advisor is incentivized. Now, on the other hand, the fee-only advisor also would like to collect assets, because managing investments is an important part of wealth management, but so are all the other things. And so typically what happens is, especially in a firm like mine, and with the way that I have chosen to deliver financial advice, we talk about the investments a small percentage of the time. We spend not a lot of time there because we have a defined strategy. It is an asset allocation. It's built for most clients. There are some variances based on things like risk tolerance and the time horizon, or how long you plan to hold the investment until it needs to be sold, liquidated, used for some other function. But for the most part, it's an asset allocation. It's set. It's a core model. We set it. It goes to work. It does its thing. It goes up and down. The market goes up and down, and it performs the way it's supposed to perform. It has a risk-adjusted return that I'm comfortable with. We're not taking a lot of risk. We're not knocking it out of the park, but we're not getting killed when the market's going down, and that's the point. We spend most of the time, and I'm going to say probably 85 to 90% of the rest of the time that we meet throughout the year, on all the other things that are happening with your life. So here's the difference. When you meet with an investment manager, they're going to talk about your portfolio allocation. They're going to talk about rebalancing. They're going to talk about which stocks are outperforming. They're going to talk about market dynamics. They're going to talk about the performance of the dollar versus the euro. They're going to talk about bond yields. They're going to talk about the interest rate curve, all of these things. They're going to offer some generic timelines and projections for retirement. They'll probably run Monte Carlo simulations for you that are some, 4,000 plus trials where if these 4,000 different scenarios happen, will you or won't you have enough money to retire on? But there's a lot of things that they're not going to walk you through. So they're not going to walk you through it, whether or not your business can sell, what kind of value it has, who the key players are, what transition methods are going to be best for you and for the way that you want to transition your business and the legacy that you want to leave and the key people that you want to benefit. They may not talk you through the value of considering Roth conversions during years where the income is lower than the year before. That can be very important. They don't talk about filling up tax brackets by way of doing those Roth conversions. They may not talk about things like receipt of income, stacking or bunching deductions. They may not talk about how to make sure that your children are prepared to inherit. They may not invite the children in. Well, they might invite the children into the meeting because they know that if you're older and you die, the kids are going to take the money somewhere else. So the advisor needs to make sure that the money stays. So they may invite the kids there just so they can start a relationship. We are going to want your children to be part of the conversation because we want them to be prepared to inherit the assets so they don't financially ruin themselves. And we're going to have a hard conversation with you about what you think about that because you know your children and it's in their best interest to be ready when the time comes. So I want to break down a few areas in addition to this where traditional advisors go silent. So first, it's your business. So if you own one, it's probably your largest asset. Many advisors treat it like a black box, something you don't open or touch because it's not an investment account. It can't be billed against and they can't control it. Plus, the hard reality is that many financial advisors are not business owners themselves. Most of them are employees of the firm that they represent, so they can't relate to your business journal or business journey, I should say, entirely. But they're happy to project whatever value you give them in a retirement plan. They'll ask you what your business is worth. You'll probably overinflate that because it's your baby and it's shinier to you than it might be to the rest of the world. And so you probably have a little bit more of a top side number for what the business is worth than if you actually did a valuation. And that's normal and that's okay, but not when you're using it to project a financial plan or a retirement outcome. And of course, they're going to look forward to the day that you sell the business because they will then have more money to manage and more things to sell you by way of managing that money. The second place that traditional advice goes silent is in tax planning. So you probably have a CPA who files your tax return, but do you have somebody proactively working on your behalf and even working with the CPA to plan for your tax outcomes, taking advantage of things like income timing, which I've already talked about, reviewing your withholding rates to make sure that you're not over or under withholding? We want to strike a really good balance there. We want to make sure that your quarterly estimates are actually good estimates for you and that you're able to meet your withholding safe harbor numbers so you don't end up with penalties and things like that. Maybe a change of your entity structure is going to change how you're taxed. Now, keep in mind, your entity structure is a legal entity that has a different tax orientation. An LLC is not a tax shelter. I'm going to say that, and people are going to be like, "Oh, that's the stupidest thing ever." An LLC is a legal structure. It's not a tax shelter. There is a difference. And so are S corps and partnerships and limited partnerships and any other C corp, any other entity structure. Those are legal structures with different tax identification or different tax applications. So you want to have somebody who understands what needs to happen with your entity and work with the CPA to sort that out. What about things like charitable giving strategies, which means money leaves your portfolio and goes to a good cause? Traditional wealth management is going to go silent on that because it's money leaving your portfolio, which means the advisor gets a pay cut. So in fact, in the traditional sense, from a tax planning standpoint, most of the tax planning that gets talked about is probably the estate tax exclusion, which is a strategy that's important for ultra high net worth clients to make sure that if your total net worth and assets exceeds that exclusion limit, well, then you probably want to do some things to get money out of your estate and put it into irrevocable trust, or maybe do some planned giving and things like that. So that way your estate's not taxed above and beyond the exclusion. The third place that traditional wealth management goes silent is in multi-generational planning. So you've worked hard to build your wealth, but will it be used, transferred, and protected across generations, maybe even the next generation? Maybe you want to do multiple generations. You want to benefit not just your children, but also your grandchildren. Advisors often skip over this conversation because it's complicated. It's also one of the most emotionally charged conversations you can have in wealth management because it exposes a lot about your family dynamics. In episode 91, just 2 episodes ago, I focused on estate planning. It's an area of significant importance. As I said, lots of emotions wrapped up. And it can be uncomfortable to ask clients pointed questions about the nature of their children, or the well-being of their children, or the mental and emotional capacity and strength of their children. It can expose issues with other family members, and those family dynamics get really messy for most people. I know it's easy to look at somebody else's situation and say, man, their family's not as effed up as mine is. But that's probably not true. People are people. And sometimes the amount of money that you have only magnifies that. It doesn't make it better. And so it can be difficult to ask difficult questions, but who better to guide that conversation than your trusted financial advisor, somebody who can think through the financial implications of how your estate plan will eventually be executed and carried out. As I said in episode 91, your estate plan is a future playbook. You need somebody who can help the players run the plays as it's written. And you want to know that that person is someone that you trust and that you feel comfortable taking over. And some people call it, the financial quarterback. I don't like that metaphor because not everybody likes football, but you can think of it as, the CFO for your life. You can think of it as, I don't know, come up with your own metaphor. But the point is somebody who's going to run point and assist the family in doing the things that really mattered to you, mattered so much that you paid an attorney to write them down and put them in legal expression. And here's the thing that's true about all of this. When we're talking about estate planning, when we're talking about generational planning, when we're talking about difficult questions, because sometimes the difficult questions aren't just estate planning questions. They can be retirement questions. They can be cash flow questions, especially if you have adult children who have failed to launch and need to come back into the home and be financially supported for a period of time. That can happen. So the ability, in my opinion, for the advisor to ask hard questions only leads to the client being able to gain financial clarity. I'm going to say that one more time. The ability for the advisor to ask hard questions leads to the client gaining financial clarity, which is what you want anyway. That's why you hire a financial advisor. You don't hire them to charge you for putting stocks in and out of your portfolio. That, as I said in the last episode, that's low value work. Higher value work is in everything else that's involved. So the last area where I think a lot of traditional wealth management goes silent is in assessing and understanding and helping you implement and make decisions that are aligned with what you value, and specifically what you value about how you behave around money. So if you go back to episode 92, I had a great conversation with Carl Richards. We talked most of that episode. We talked about things that absolutely reflect and impact your values and how you behave around money and how you think about money and what your emotions do around money. And I think real planning starts with asking questions like, what kind of life are you building? What's important to you about the way you use money? If you woke up today and you had everything that you needed, what would you want? What do you want for yourself? Famous Doug Lennox question. Doug Lennox, author, teacher, former advisor, big in the Ameriprise universe. What do you want for yourself? He's so in the lexicon of Ameriprise. It's called the witty whiffy, and every Ameriprise advisor knows witty whiffy. What do you want for yourself? And then I think that's an important question. What are you doing? What do you value? What's important to you? What's missing? Right? These kinds of questions. It's not just about returns. It's about aligning your money with what's most important to you. And I think it's important. It's so important that at Life Moves Wealth, one of the first things that we do when somebody becomes a client is we spend a few minutes working, and usually it's more than a few minutes. Sometimes it takes a couple of weeks, working on writing and defining a statement of financial purpose. If you go back and listen to episode 4 of the Financial Purpose podcast, like way early before I had good microphones and before Josh was producing this thing and making it sound good, before I had my rhythm in place, but that's still a really good episode. It helps define what the financial purpose is. My financial purpose is 3 parts. The first part is that I have to remember, and that's an important word because I have a tendency to be a workaholic. So I have to remember to make time and resources available for family adventures. Second part is I want my business, my firm, and the business pursuits that I have to be productive and profitable so that Melissa has options with what she wants to do with her career. She's at a point where she's been in her career for quite a while. She may want to start teaching. She may want to be in it on the administrative side. She may want to take part of the year off. She may want to go part-time. She may want to go only private practice. She may only want to go PRN because she's a physical therapist in home care. So I want her to have options with what she wants, and we don't necessarily need to be tied to her paycheck for our basic expenses. And then the third part is I want to give freely. So I'm in the community. I'm a charitable person. I own a nonprofit. I want to be able to give money to the community and to things that matter and that make a difference. Because again, I believe that you should be a contributor to your community, not just a consumer. And so that's important to me. It's part of my financial purpose. So if I'm making a financial decision, it needs to align somewhere along those 3 things. And the more that aligns with, the better. And that's how we use the financial purpose. It helps people stay aligned with what they say is most important to them. It's very important because some decisions are not a matter of math. It's a matter of, if you do this, what will the impact on your life be? Okay, now let's go back and do the math and make sure that the numbers work. We don't start with the math, we start with the person. And that's a very important distinction. So what real planning looks like, in my opinion, is a real planner, as I think, over many, many episodes said, is not just managing your investments. We are a strategic partner for you because we do things like think, act, behave, advise like we're the CFO of your life. In fact, one of the advisors that I learned from early in my career would say, I'm the CFO, husband and wife, whatever the couple composition is. You are CEO and chairman, chairwoman. You can figure out who wants to hold what title. But the point is, my job is to know everything about your entity, your business, your organization, whatever we want that to be, your enterprise. My job is to know everything about it and advise you on it so you can make well-informed decisions that are profitable for the entity, for the enterprise, for the structure, for the company, for your personal life, whatever that looks like. We're going to help you do things like structure, optimize, protect, grow your wealth in all forms. Now, because I don't bill by assets under management and I don't earn commissions, I'm interested in building wealth with you wherever that needs to happen. Some clients want money in other places than just the capital markets. Some people want real estate. Some people want multiple businesses. Some people want to collect art. Some people want to collect cars. Some people want to collect commodities. Some people want to have a decent amount of money in crypto. Some people just want cash. And all of that can be okay if it's done in the right structure and order and strategy, because to me, it doesn't really matter where the money lives as long as we can manage it together and grow wealth, however we're doing that. We're going to coordinate with your CPA, your estate attorney, your business partners. Probably what we're going to do is come into your business and do financial literacy and financial education for your employees. Why? Because there's a lot of studies around employees who have access to good financial literacy and good financial advice, some sort of financial advice. They tend to show up to work more often. They tend to be less financially stressed. They tend to have their life in order so they're not calling out sick. They tend to have their affairs in order so their house isn't a mess and their money's not a mess, and they're not getting debt collectors, and they're not, having their paychecks withheld for other things or garnished wages or whatever. They just have things going for them simply because they've had access to good financial literacy. And I've done my fair share of financial literacy. I've brought my friend Sarah Van Hoosen, who I've talked about on a few episodes, and she's even been in an episode. If you go back, I don't remember the episode number. I want to say it's somewhere in the late 20s, maybe early 30s. You'll find her, Sarah Van Hoos, with Journey to Influence, and you can look her up at journeytoinfluence.com. She does great financial literacy as well. So when your employees have access to that, it's better for you. It's better for the business. And we're going to charge you for the advice that we give and the value that we provide, not just the size of your investment account. We don't avoid the hard stuff. We dig into the complexity. We like doing things and should be doing things like talking about planning for your business exit, the inheritance plan of your children, which I've already talked about, and even all of the emotional sides of a financial decision. Here's a great example. When I first became a financial planner, I was leading a meeting. I was sitting, going through an agenda. It was a defined agenda. And I got to just the cash flow section. So we were maybe 15 minutes into the meeting. And the client said, hey, this was the wife. She said, you know what? Cash flow is going to look a little different because I'm considering quitting my job and being a stay-at-home mom for a few years because the kids are at the age where they're doing soccer and band, and I want to be a classroom mom and I want to spend time with them. And I want, this is important to me to be the mom for a couple of years. And I sat my pen down on the table and I kind of pushed the agenda away from me a little bit. And I just said, tell me more about how that feels to think about. She was an executive. So I wanted to know how it felt for her, how she was processing the decision of stepping away from her career. She's educated. She paid for the education. She worked hard. She became an executive, and now she's going to step back and be a mom for a few years. And so she talked about how she felt about that decision and what her considerations were. And then I asked her, how would she plan to keep her skills sharp? Because it's no secret that it's very difficult for women to leave the workforce for a few years and then go right back in or try to go back in, because the employer that you're interviewing for is going to see a gap of employment, and it doesn't look as favorable for women. Unfortunately, that's just the reality of the world that we live in. But that can be questions, and there can be questions about, are your skills still sharp? Can you still make good decisions? Can you still run the type of schedule that you need to run to be successful? Can you still, whatever the next thing is? And so she talked about her thoughts on that. And then I turned to her husband and I said, tell me how you're feeling about this decision. Because now you're going to go from 2 incomes to 1 income, and that just puts a little more pressure on you. And he was a salesperson and a very successful one, but it meant that he was probably going to have to do a little more. And so he talked about his feelings, and we had a great conversation. We did not get to the rest of the agenda. Why? Because the rest of the agenda no longer mattered, because something very fundamentally important, a financial purpose, was changing. And so that's hard stuff, complex stuff that you really need to dig into, because I need to understand the people that I'm working with, what's happening in their heads, what's happening in their hearts, and the distance between those two things in order to be a good advisor to them. And so, as Carl Richards in episode 92, the most recent episode, said, and I agree with this, real wealth management isn't just math. It's not a math problem. We deal with numbers, but it's not math. It's meaning, it's mindset, it's mechanics, it's emotions. It's all working together. And money is a deeply, deeply human experience. And so we need to spend time there. Spend more time on the human and less time on the math, if that makes sense. So maybe the best way I can sum it up, no pun intended, because I just said that it's not a math problem, is this. When I talk about the work I do, I talk about it exactly with that 4-letter word, work. It's pressing into things. It's digging deep. It's kneading the problem, like you would dough, right? Kneading dough. It's massaging things. It's thinking. It's asking questions. It's researching. It's analyzing. It's testing, and it's providing advice through deeper, meaningful conversations. And the only way you get at that is to be incentivized to care more about the person than just the rate of the return or the asset allocation or the composition or the stocks or whatever's high flying. And in my opinion, those investment only advisors, because they're investment only, are really one dimensional. And that's why I chose this particular path for serving clients. It's a vastly different experience for them. It's way more enjoyable for me because I spend most of my time in higher value conversations. I saw something last week where it's like your financial planner is like a therapist, but with a calculator. And I thought that was kind of funny, but it's true. There are times where there's a box of tissues in my office. They're not for me, but I've had that. I've had couples argue in the middle of a meeting and then leave the meeting on better terms. I've had people come in because they just lost someone very important to them. And that's a very emotional conversation because we're talking about how we take care of the human while we're doing all the things that have to be done when somebody leaves this planet. And those are all higher level conversations, and the money does what the money's supposed to do. The rate of return does what it's supposed to do. We're working on the human. So as I kind of close this, here's the question. I want you to ask this. If you are meeting with a financial advisor, or if you've met with an advisor, or if you currently work with an advisor, ask yourself this. Are they helping you manage your entire financial life? Or are they just focused on your investment account and how much more money you can put into it? Are they bringing strategic ideas to the table? Or are they waiting for you to ask? Are they proactively telling you where you stand financially? Or are they waiting to give you the once a year 35, 40-page financial plan, or the 2-page Monte Carlo simulation, or the statement that all the numbers have to be black, none of them can be red, or they all need to be green, none of them can be red? Is that where they're spending their time, getting rid of their red stocks? Are you paying somebody to protect and grow your wealth? Or are you paying somebody to rebalance based on a pie chart? or based on current market conditions? I think the answer to those questions is very important, and that's how you know whether or not you're working with a real advisor who's going to do the work of helping you grow and protect and manage your wealth versus the lower cost percentage online platform with the big name, whatever. I think it's important for you to really think through that. If the question is, why should I pay more to get more versus pay less to get less? Because that's really what it is. So if you're ready for a different kind of conversation, one that's rooted in goals and your story and what matters to you and your whole life and not just your portfolio, then maybe it's time to work with a real financial planner. And I would love to help you, or I would love to refer you to a planner that may be better suited for you than me, because I can't work with everybody. Not everyone is aligned with the same way that I see the world. I frustrate some people. Other people love working with me. And so let's get you aligned, not only with what's important to you, but also with the right advisor so your outcomes can improve and so you can have somebody that you're comfortable talking to. I have clients who hired me just because between the husband and wife, both of them felt like either of them can call me at any time for any reason and have a comfortable conversation. Challenging conversation is needed, but comfortable just reaching out to me directly. And I think that's important for both of them to have that comfort level. So if that's what you're looking for, let me help. Reach out, info@lifemoveswealth.com, or go to lifemoveswealth.com and hit the schedule time with me button. And I'd love to help you. So I hope this has you thinking differently about financial advice and about what you're getting and what you're not getting potentially, and maybe what you should be receiving from the person that you're paying to help you manage your money. And when we talk about managing money, we're talking about managing your life and your emotions and your head and your heart and your kids and your family dynamics and your cash flow and all the icky stuff that comes with money and all the feelings around it. That's what we're here for. So if this has been helpful to you, if it has you thinking, share it with somebody else who you think can benefit from this conversation as well, because we all have friends. None of us talk about money because money's embarrassing. Every one of us talks about the last stock we bought that shot the moon because we're proud of our winners, and we just don't say anything about our losers when it comes to investing. And I think it's important that we talk about money. Money becomes not taboo, but becomes the thing that we work with you to optimize and to improve, and certainly to make adjustments as your life is moving around, so that way we're actually building wealth the right way for you, on purpose, with a purpose, aligned with your purpose, if that makes sense. So that's what I have for you today. Thanks so much for listening and watching. And until the next episode, go be a boss. Take care. Thanks for listening to this episode. Be sure to like, subscribe, and share. To learn more about your financial purpose, visit lifemoveswealth.com.